Hello, everyone. We'll just give folks a minute to jump in. All right, let's go ahead and get started. Hi, welcome to today's Tech Talk, Tracking and Verifying Funds for Regulatory Reporting. My name is Chris Frakes, and I'm the head of content at Modern Treasury, and I'll be your host today. Joining me are two people who are very familiar with tracking payments and managing ledgers. Foster King is one of our product managers, and Jack Iverson sits on our sales engineering team. Okay, so before we jump in, a couple housekeeping items to cover. First, today's sessions will be recorded and we'll share everything out afterwards. Second, this is meant to be an interactive session. So if you have a question, you can hit the Q&A tab at the bottom of your screen. We'll do our best to get to all your questions by the end of the session, but if we miss yours, we will be sure to reach out afterwards. Now, before we dive into the technical stuff, we do a thing here at Modern Treasury where before we start a chat like this, we share our food hot takes or deliberately controversial take on food items. For example, like whether or not a hot dog is a sandwich. So I'm going to start with mine, which is cakes are the bottom or at the bottom of the dessert ladder. I don't like cake. I did not have a wedding cake. We had pie and donuts at our wedding, which I feel are the superior dessert items. That is my food hot take. Foster, what's your food hot take?
I actually agree with that one as well. I think that's great. Mine is coffee should only be enjoyed hot. So I kind of vote that we get rid of anything iced. So that's mine. Yeah.
Jack?
Nice. I also agree with the cake take, so I don't know how hot that take was, but I
Oh
think maybe a
man,
lot of people
yeah,
disagree.
it's a medium, it's a lukewarm take then.
Mine is I have my whole life hated caramel. I think it's like sickly. It's like too sweet. Whenever there's too much caramel in something, I just find it like sickly. And I'm a very not picky eater in general, but it just, I don't know, something about it.
All right, well, there you have it. Those are the Modern Treasury food hot takes for this session. Now that we've broken the ice a little bit, let's get started. Foster, maybe we'll start with you to explain why companies who deal with payments need to even consider reporting requirements and what those reporting requirements are.
Yeah, definitely. I think that the important thing to note is that anyone who moves money on behalf of their customers, we call those third-party money movers, MSBs, if you would, multiple different names to refer to companies that move money for their customers. They all need to think about various types of reporting. So the first one to think about is based upon the classification of a business, right? Are they a money transmission holder or are they using an FBO account, et cetera? How are they holding and moving these funds? And so that really comes down to it. So any financial institution is going to implement some sort of reporting requirements onto their customers. So if you're using an FBO account and handling funds on behalf of your customers under your bank's TIN, as an example, then you'll have to report to your bank and be responsible to reporting to your bank on, customer funds, things along those lines for your bank safety to make sure that they know that you're good stewards of their funds and that you're a good customer of theirs. However, if you have money transmission licenses across various states, then you're now reporting to the states as far as whose funds you're holding. And so the states that are granting these licenses need to make sure that those that are holding those and moving funds for their customers are responsible and can be trusted to uphold those licenses as you would. And then additionally, it goes down to specific industry reporting as well. So lending, you might have to report on your loan balances to, various regulatory bodies. If you're getting into investing or any sort of crypto, things along those lines, there's various bodies to report to as well. But I really like to think about it as that way. Anyone who's moving funds, you got to report to the bodies that are responsible for granting you that permission to move those funds. And so an easy way to think about that is as an FBO holder or an MTL license holder.
Yeah, something that I want to jump in and add here as well is that I think we're all pretty familiar with the reporting requirements that traditional businesses have, where they might have to report on like quarterly earnings if they're public. They might have annual reports that they're generating for public consumption. But as Foster is alluding to here, the types of businesses that we are talking about here that have, say, FBO accounts or money transmission licenses or are lending companies, they are money movers as a core part of their business. And as a result, these requirements are heightened and likely need to be fulfilled on a more frequent basis. So an auditor might just appear out of the blue and ask them to verify what happened with somebody's payment through their flow of funds. They need to be prepared to do that. If they are following a more standard month-end close kind of slow process of getting their ducks in a row, then those types of requests coming out of the blue could be like a real curveball. It could pull away like product managers and engineers from other work that they're doing in order to meet audit requirements. And so these types of businesses have to have an internal motion around fulfilling these requirements continuously.
Yeah, that makes sense. And like Foster said, at Modern Treasury, we refer to these types of companies that move money and companies involved in third-party money movement. We say that they're third-party money movers. They're moving money on behalf of other parties. These types of reporting structures are different, like Jack said, than like first-party money movement, the usual kind of like APAR, any type of general money movement that a company needs to function. This is separate from that. And we like to say that these third-party money movement companies, quote unquote, sit in the flow of funds. That is, at some point, money is moving through their own systems and that they're on the hook for those funds, which is why there's so much regulation around it. So maybe back up a bit and we'll say, like, why would a company want to sit in the flow of funds if it comes with like all of this additional scrutiny and all of this additional reporting rigor?
Yeah, I can go first, and Jack, if you have anything else to add, feel free here. But it is really an important decision for a company to make of when is the best time to move into the flow of funds, if it is the right time, etc. And there's a few key drivers to that. The first of which is the customer experience that you want to be able to power. Once you're moving into the flow of funds, you have more control over when your money moves to your customers, settlement times, the types of rails that you have access to, etc. You're much more in control of those types of factors that you want to be able to have your customers or users benefit from. That's usually the main driving force, are the customer experiences that you want to be able to power. The second to that is, of course, there are financial opportunities to moving into the flow of funds. So you can capitalize on any sort of float or interest from the accounts if you're holding funds on behalf of your customers. This will all come down to the various licensure that you have, as well as what your banks are willing to offer. However, there's usually financial opportunity in that. And then, of course, there are ways in which you can move off processors, cut down your fees in that SaaS spend, etc. So it just gives you more control of your destiny in that way. I don't know, Jack, if you have anything else to offer there.
No, I think that's obviously all right. I think the analogy we sometimes use is that sitting in the flow of funds is like getting closer to the metal. You're getting closer to controlling everything that you want to in your product. So to Foster's point, this is going to bring like customer experience benefits. You're not outsourcing some of your customer experience to other parties. But of course, it comes with trade-offs that we're talking about today.
Yeah. Okay. So I get that there's like a CX element to it. There's a revenue element to it. Maybe let's get now to like the meat of the tech talk. And Jack, maybe we could start with you. Can you help me understand why these companies like face these challenges with regulatory reporting?
Yeah. Fundamentally, moving money is really hard, but it always sounds really simple. And as we said before, with more traditional businesses, the scale of payments is relatively low. And so it can be handled by, say, a team of people. It doesn't necessarily require a lot of software to handle all of this. But when businesses are moving money at scale, there's 4 core things that they need to be able to accomplish on a regular basis, which is sending and recording a payment intent. So maybe it's helpful if this is less abstract. Let's take like an example of a business. Let's say that you're like, I don't know, Bill.com. Like Bill.com is a giant money mover. They help businesses to pay invoices to their vendors or collect on invoices that they are sending to people who owe them money. So if you think about their flow of funds, they're perhaps debiting from somebody or crediting funds out to somebody else. They need to be able to execute payments and record that they executed those payments. They need to be able to confirm and reconcile that those payments took place as expected. Again, maybe that sounds obvious at the scale of a single payment. If you think about your bank statement, like, yeah, I paid my rent. Yeah, I paid my mortgage. But if you're Bill.com and you execute tens of millions, hundreds of millions of payments a year, it's a non-trivial challenge to actually do that. So you have to confirm the payment succeeded. After that, they have to actually ledger all this information. They have to have some system of record that is tracking funds that are in flight. If they have, to Foster's point from before, like an FBO account sitting at a bank somewhere that's holding many customers' funds that are in transit through their ecosystem, what's in that bank account? The bank account has $10 million in it. Like, how does this actually get bucketed up into funds on behalf of their customers? And then lastly, they have to be able to produce reporting on everything that happened with these payments. So we were fulfilling this invoice on behalf of this customer, and so on Monday we debited from their bank account. On Tuesday it landed in our bank account. On Thursday it left our bank account and was received by our customer or by their vendor that we're paying out to on their behalf. You need to be able to generate those sorts of traces. And so this is something that we see companies across many verticals doing. I'm using Bill.com as an example because it's a relatively simple flow of funds, but this is applicable across any business that's sitting in the flow of these payments.
Okay, so like 4 things are needed. There's you have to standardize the payment data. There's the strong ledger. There's reconciliation logic for these complex flows, and then there's reporting and auditability. And each of these comes with their own set of challenges. I know between the two of you, you've talked to so many customers and prospects, so many companies who have found out about these needs the hard way. Of those 4 things, what do you think is the most important thing to get right for reporting success?
Yeah, I think that there's 2 key pieces to this. I'm curious, Foster, what you think of this as well. But thinking back to the 4 things that I just shared, I think combining payment execution and reconciliation of that payment, I sometimes call that like closing the loop on a payment. So like, yeah, you go to your bank and you send them instructions for 1,000 payments, and that just kind of goes off into the ether. You do have to confirm at some point that those 1,000 payments all succeeded, and if 10 of them failed for some mix of reasons, like, oh, I tried to debit from this person, they didn't have sufficient funds, like being able to close the loop on the payments is a really challenging problem at scale. And what we see a lot of businesses do is apply a combination of software and operational resources to that problem to try and do that as quickly as possible, especially if the payments keep coming day after day. You can't let this snowball too much, or else you're going to be buried in payments that you have to reconcile. The other side of it would be accurately ledgering all of this. So tracking that the funds are in flight, ensuring that you have up-to-date real-time balances. And again, I think that relies on that payment loop being completed, because if you're trying to move payments end-to-end through your ecosystem quickly, you need to know what has happened so you can make accurate decisions and then be able to generate a report on what happened. To the extent that there's any delays in this chain of events, that can just create downstream issues, funds that are missing, and we actually hear about businesses having to just write off money that fell between the couch cushions, essentially. They thought they facilitated a payment and didn't, and there's only so much you can do about that.
Oof.
Yeah, I think just to step in there a little bit, I do agree with Jack that both those are quite important. I think my take on it though is that the ledgering and really the real-time tracking of those funds is probably the most pivotal foundation that you need to set. A lot of times, and we've seen this with customers of ours, the reconciliation and traceability is definitely a requirement. You need to make sure that you're reporting on the accurate movement of money from your accounts. However, a lot of that can be retroactive. So as your processes for reconciliation are catching up, it doesn't need to be as real time necessarily as the tracking of those funds, right? And making sure that your ledger is immutable in that sense requires it to be real time and set up correctly from the start. So I think that's where I would start if I was recommending to anyone, is get that foundation of how you're going to track the funds, and then tracing the movement of the funds as well. On top of that, back to the bank transaction is something that you can add on and bolster your processes around as you continue to get more mature.
Great point.
And then I think outside of that as well, when we think about like the ledger design and really making sure that it'll work for your use case, that goes hand in hand as well with making sure that you have necessarily the right tech or the right guarantees baked into your ledger. It's also making sure that you're accounting for your proper money flows. So really step one is understanding what are your flow of funds, how do your customers move money through your platform, and what are you responsible for reporting on?
That sounds like, I know for me, it sounds like those are like mainly basic questions, but I know that can be kind of difficult when you're talking about thousands and thousands of transactions at scale. Not that you can share specifics, but I know you both have talked to teams who have learned this lesson the hard way. Can you give folks on the call an idea of what's at risk if you don't do these things correctly?
Yeah, definitely. And I'll anonymize any of these stories, but a lot of our customers deal with these issues. So, for example, a large property management company that we work with does MTL reporting through Modern Treasury, and so we handle all of their organization of ledgering of those transactions as well as generating those reports. And so having the foundation of where to move or how to track those funds properly, I should say, is really what they came to us for. We've seen, as an example for them or other customers, not properly tracking these funds leads to disorganization and unreliable reports that you can pull. So just as a clear example for an MTL holder, you will need to report on volume for every state that you make transactions within. You also need to report on extinguishment of the liability that you move through that state. And so having very concrete places where you're tracking those funds is not something that every customer is thinking about as they get their product up and running and off the ground. However, it will come back to bite you when the regulators come around every quarter and you need to report on those values accurately. So not being able to get down to the actual transactions that make up those numbers was something that we found in a lot of these customers there. So it just really leads to long audits, redigging through your transactions, refiling if you need to, etc. And it just makes these processes more arduous than they need to be.
Yeah. As Foster's explained that story, that's of course a business that is operating with money transmission licenses, which comes with its own state-by-state requirements. A lot of our customers, as Foster described near the top of this call, they have FBO accounts or sponsored account structure. Banks call this different things, but essentially the idea being that you are renting an account from a bank and moving money through the account, and the bank owns the account, so you are on the hook to report to the bank on what's happening in that bank account. And so, as an example, we're working with a large consumer fintech in the US that launched a debit and savings account product on Modern Treasury's ledger, and what they are needing to do on a regular cadence is all these accounts that they're holding on behalf of customers are sitting in an omnibus account at a sponsor bank, and they're needing to generate end-of-day statements to the bank about what's in that account. I joked about this earlier, but there's $10 million sitting in this bank account. Like, whose money actually is this? Because it's actually earmarked for all these different users, and because it's the bank's bank account, the buck stops with them from a regulatory perspective, and so they are then going to pass those requirements through to you as the fintech that's leveraging that bank account. That can be challenging to do at scale, and so that's why they're relying on a third-party ledger to track all that.
Yeah, that makes sense. I'd even add, not that like there are very public headlines of what happens when this money isn't tracked properly. I'm thinking about things like Synapse and like FTX and others in the industry they're pretty stark reminders. Not that we need them, that your ledger has to be right and it has to be auditable. And obviously the risk here is a spectrum from, business disruption, which is like operational cost and like trust erosion. And on the other side of the spectrum is like monetary penalties to the tunes of millions and millions of dollars, and or indictment, which is, not great. So before we open it up to audience questions, I guess I'll say my one last question, which is kind of turning this question on its head, which is how are real-time payment rails and stable coins pressure testing reporting? Because I feel like with stable coins in particular, we're seeing a lot of the rise of use cases. And if money moves instantly, but tracking isn't instant, I'm assuming that lag is costly. And how are companies dealing with this?
Yeah, that's a great question. So as we discussed earlier, the typical approach most businesses take to reconciliation and ledgering, broadly speaking, has humans in the loop. It's kind of an asynchronous process, to get a little tech jargony. That's not really possible with instant payments. If you're moving instant payments through your business 24/7, 365, you need to have processes powered by software that reconciles and ledgers everything that's happening as close to real time as is possible. Nothing's ever perfectly real time. You're, of course, going to have exceptions and different things that break that system. And they're, at least in the near term, humans are always going to be in the loop to some extent. But in a world of instant payments, these problems become even more stark because people are now going to start expecting a very real-time experience. And if a user gets funds instantly deposited to their account, but they're not allowed to withdraw them yet because you don't tell them that they have their funds, but they know their funds are there, that's going to create a challenging customer experience, to say the least. So I think it just makes these problems even more acute for a lot of these businesses.
Yeah, I think just to go off of what Jack is saying as well, we're seeing this shift where things are becoming faster and the tech needs to catch up in a way. So in the example you mentioned, right, like if I'm sending an instant payment to one of my end users, consumers, etc., they want to be able to see that show up on their app, wherever that wallet might be held, customer funds, etc., as soon as that money moves. What we're seeing is that a lot of this reporting is kind of lagging to after the fact, if you would. So we're still on prior reporting, but trying to move funds instantly. And so it's playing this game of the tech catching up, if you would. So I think an important thing to think about when we're talking about instant payments and RTP, stablecoins, etc., the various forms of that is this can be done through a variety of fashions. One way is how you ledger those funds to your end customers, right? Do you make them available instantly? Do you wait for reconciliation? These are important questions to ask yourselves as you want to offer these types of experiences, as well as, which type of reporting are you relying upon for the reconciliation of those funds, bank confirmation, et cetera. There's all varying levels of reliability you can get across these partners. And so just as customers want to get funds faster, you also want to be able to make them available faster. So I think that's really important. But the flip side to that is that there are, of course, risks, right? The faster you move and the quicker that you want things to get out of your platform, onto your platform, et cetera, on-ramp and off-ramp, the more you're opening yourselves up to AML, fraud, et cetera. And so a key thing of RTP is that, we don't have all these safeguards like we do with ACH, right? So there aren't these large return windows, reversals, et cetera. So it makes it really important that you have a holistic solution around screening, transaction monitoring, any of your own internal risk appetite, and making sure that you take that into account when you're offering these faster payment rails.
Yeah, and one thing that I'd add to that is that some of these risks that Foster was talking about is I think the risk of dispute remediation and like this new paradigm is one of the primary drags on ecosystem adoption of instant payments. So I remember in the very early days of FedNow being rolled out, reading about a lot of US-based banks that were hesitant to launch it because they had never, up until that point, needed to have 24/7 support. And so just that alone, like, okay, now we're in a world where money can move Saturday afternoon. Nobody's around Saturday afternoon. Like, this is a totally new paradigm for us to have to accommodate. I think we're seeing that change. People are realizing this is here to stay. People want this. We need to get on board. But it's just a drag on everybody in the whole system because they're used to asynchronous processes. So, yeah, really interesting.
Yeah, I agree with that. I think just to tie it fully back to reporting, as you would, treating this the same as your other payments it again goes back to like having that strong foundation of tracking first. So if you're putting these in the correct buckets and then making sure that you can put those reconciliation processes into play.
Yeah, and actually to that point about reporting, in theory, once all the kinks get shaken out of the system, the irreversibility of payments like RTP and FedNow will actually make a lot of this easier, because a big challenge that a lot of businesses face today is that ACH returns introduce a lot of challenges in tracing payments through their whole system. So if you debited somebody and then it got returned and then it succeeded and then you paid out and then that returned, you can just imagine all the steps that you're having to report. If everything's instant and irreversible, that actually becomes a simpler problem. We just have to get there.
Yeah, no, that makes a ton of sense. Thank you both for your answers. I'll take this time to remind anybody who's on the call that we do have a Q&A button at the bottom of the screen. So if you have any questions for our guests, please do use that Q&A button and ask them. I'm going to go now to some audience questions that we received from social media, guys, if you don't mind. The first one is kind of in the same vein as real-time payments, but this one is about how do you audit a stablecoin transaction? Is that different than fiat? Is it even auditable?
Mm-hmm. Jack, do you want to give this a go, or I can go first?
Yeah, I can take a stab at it. I think there's a few pieces to this. So, for one, stablecoins are, although we're probably primarily talking to a US-based audience here, and so most transactions are happening in USD, fiat, and most stablecoins that are used around the world are tied to USD, like USDC and USDT. They should be treated as a separate currency, as a separate asset, probably within your ledger. You shouldn't actually treat it as dollars, even though it's tied one-to-one with the value of dollars. In terms of traceability, I think it's going to look a lot like the way that we audit fiat payments today, which is that you have your own internal system of record that's tracking payments that you think should happen. But in most cases, for businesses that are transacting using stablecoins, just like in the world of fiat, there are third parties that you are interacting with to get access to the payment network. So in the world of fiat, that's your bank partner. At the end of the day, the buck stops with them. If you think something happened and it didn't happen, the bank is going to be the last recourse that you have to try and figure out what happened there. And in the same way, many businesses are relying on like third-party on-ramp, off-ramp partners like Bridge and Circle. And so you're going to have your own system of record. You're going to be communicating with these systems to try to build an auditable trail of these transactions. If ever there's variance between what your own system of record says and what these third parties say, that's when you're going to have to come to them. And it's going to make that conversation a lot easier if you have an auditable trail of what you think happened with that payment, with as much context as possible, and then you can go remediate it with them. I think it's the same problem. It just feels a lot more, 21st century to have it happening in stablecoins and not ACH payments.
Yeah, I definitely agree with that. I think one other thing to add here is that, and we're still seeing all this unfold with stables as well, right? So what's going to be required, how will we need to report on it, things along those lines. However, one thing that I'm pretty sure we will need to be able to report on are going to be conversion rates, right? So if we're talking about, international payments, there's going to be a conversion of stablecoins to the landing currency. That would be inclusive of USD, where it should be one-to-one. However, in the future, being able to report back on this is how much the customer received, which equaled this amount of stablecoins, is going to be important as well.
Yeah, no, that makes total sense. Actually, that I'm going to skip around a little bit. This other question seeded from social media: how do you deal with reconciliation across time zones and currency types? That kind of, when you're talking about like different rates, that just kind of triggered me to jump to this question, Foster.
Yeah, definitely. I will start with that time zones are very hard. Time zones are definitely one of the harder things about software, especially globally moving money. Everyone operates across 24 hours in a day. However, those 24 hours are different depending on where you are. So it's really important first to standardize the time zone. So we see extremely common for people to use like a UTC or wherever their headquarters of their corporation might be as that time zone, and making sure that you're anchoring on one time zone. So if you're tracking funds, you don't want to be tracking those in a time zone specific manner. However, just in a default time zone. It's definitely something I'd recommend for everyone. Doing the conversion from UTC back to EST, etc., is quite difficult and can lead to a lot of issues down the road. Something that's pretty hard to manage, especially if we have different rules like daylight savings times, things like that might not apply everywhere. So definitely anchor around a central time zone. UTC is the most universal. If you can make that work, that will make a lot of things easier, and a lot of software works off of UTC as well. That would be the first one I would say, and then currency, being flexible to various currency around the world. So making sure that you can, I'll give an example for Modern Treasury, we ledger in multiple currencies, right? So we allow you to store funds across multiple currencies. I know that customers do this, with all of their money flows that are international, being able to store euros, pounds, USD, etc., all in one place so that you can easily, again, report off of that, have one source of truth versus various sources of truth for each different region that you're operating in. That's quite important there. And so really anchoring around having different currencies by the fiat that you're offering those specific experiences. But if we look back to stablecoin, there's also going to need to be, custom currencies, right? So we saw this with crypto when, everything came out, back when crypto became very popular, and the new coins that were coming out, people are trading these, various cryptocurrencies, and we need to account for the tracking of all of those, whether it be an investment app, a wallet, etc. So also having the ability to track custom currencies as they come up. Jack, I don't know if you have anything else to add there.
Yeah, I guess the only thing that I would add is just speaking to like the timing piece of it is that what we often see with a lot of international payments, and hopefully stablecoins will resolve this largely because it's going to be instant, like we were talking about. But with a lot of older means of transacting, so like Swift wires or any other like international payment method, there is a delay in confirmation that comes with this, which can introduce its own problems as well. So you're kicking off a bunch of payments and then you're hearing about them at some point, and so you have to have some way of modeling in-flight payments and like earmarking those funds in some way, so you can ledger them all properly and be able to report on those. And you might need to then be able to go back and retroactively update things depending on what you hear from these third parties. Ideally, in the world of stablecoins, that's a non-issue because you're just sending USDC to somebody else's wallet. It's instant. But just one thing to consider, I guess, in the near term, because while stablecoins are really exciting and we're very bullish on stablecoins, our CTO Sam has a funny line that payment rails never die. People still send checks every day. So I think old school ways of converting currencies are going to be around for the foreseeable future as well, and we have to be able to accommodate those as well as things like stablecoins.
This one just came in as well as kind of goes along with that. We're already processing payments, but reporting is messy. Is it too late to implement a ledger?
No, it is never too late to implement a ledger. It might be the exact right time to implement a ledger. A lot of the businesses that we speak with that have those types of issues, implementing a ledger can serve actually as a forcing function to resolve that kind of issue. So we have businesses we work with today where the first touch point they had with us was implementing a ledger as a central system of record to solve some of those reporting issues. And by normalizing against an in-house ledger, they were able to identify where reporting issues were coming from, what systems of like payment information were causing those issues, and it gave them the flexibility to actually change their flow of funds in certain ways that made reporting easier. Being a little vague because I'm anonymizing a handful of customer stories behind the scenes. But yeah, I think that that's probably a sign that ledgering is broken within your business to some extent, and that looking into implementing a ledger could actually resolve some of those problems and would serve again as like a forcing function to investigate what the causes of those issues are, which might be very fuzzy and challenging if you're just putting out fires all the time. If you go through the full engagement, either internally or with a third party like Modern Treasury, to really understand what it would take to ledger all of your payment flows, that will surface what's working and what isn't within your business and could just help to resolve those issues.
Yeah, I think just a couple things to add on as well. It's all going to be a journey, right? So you can continue to improve across all these different parts of your reporting processes. The reality is that when you spin up your services from day one, your reporting requirements are going to be vastly different than in year 5, right? So as you get more mature, you take on more licenses, more responsibility, etc. You're offering different use cases. Your reporting requirements are going to be, quite different and continue to mature in that sense. And so likely you don't have a reporting structure set up from day one that will suit you for the future. However, having a flexible foundation to be able to add those use cases on or add those requirements on, definitely something to think about from day one. However, you can be nimble and adapt as you go. So it's never too late. Like Jack mentioned, it's probably the right time, actually.
Great. And this other question, I guess kind of maybe goes along with it. How do you design for real-time traceability across multiple systems? I'm not sure if the asker can verify multiple systems, but real-time, I'm guessing there's probably a few accounts.
Yeah, I think I can take a stab here. So as far as we think about real-time traceability, right? If we're thinking about maybe instant payments in that sense, or even payments being able to be traced as we send them, maybe like an ACH or things along those lines. Um, the various systems that you're utilizing, so say you're using a card processor, then you're also making payments through your bank. Maybe you're using some sort of crypto brokerage, etc. Right? There's various systems that you're moving money across. And so this again goes back to the foundation. Having one central place to track all of that is extremely important. So all of these various systems might give you some sort of, reconciliation out of the box or some, reporting of your payment intents, things along those lines. You might be able to get records from each of those, and you also might have your own internal DB that has these records too. However, combining all of those sources into one place will allow you to have proper traceability in that sense. So I think that's step one. So step one is having a central source of truth, your true system of record, if you would. The second step is architecting for this. So if we go back to the example of, say, you use a processor in a bank to send different types of payments, and I want to track when I sent money through the processor, when did it land in my bank, and when did it go out to the customer. You can account for this by architecting for various ledger accounts. If we go back to the ledger example, or however you're tracking these funds, maybe a reporting category, etc., where you can tie together these transactions through common metadata values, or maybe you have specific IDs that you can look up. But being able to link together the different stages of that transaction is very important, whether it's an explicit link or inexplicit through some sort of metadata key. That's really important. And then additionally, just tracking the value through different accounts dedicated to each system. So you might have a processor receivable, processor payable, customer wallet balance, and then additionally, maybe you have your bank balance. And being able to track all of those balances in one place will allow you to report off of it properly. So I think I would leave that there.
That makes sense.
I think I know we're focused primarily on reporting here. The one extension I would add to that is that having that central system of record also serves as a ledger service for parts of your product in very powerful ways, which is one of the most common use cases for MT. And one of the reasons to have a central ledger is that you then have a ledger service that can power your UIs and your product decisioning and all of that. And having that be the same system that powers your reporting and your immutable traceability of every payment through every system, that's just powerful for a business. It's safe from a regulatory and reporting perspective. It's also powerful from a product perspective, rather than having information siloed in different places that you're then having to keep in sync with one another, which can be really challenging.
Yeah, makes a lot of sense. I have one more question here that I'm seeing, unless anybody else has questions that they want to come in. This might be the last one for the day, which is what metadata should we be capturing to report easier, make reporting easier?
Yeah, definitely. I think that's a really, really good question to think about when you're starting this process here. So when we think about metadata, we think about flexible ability to add business context to whether it's your ledger transactions, your payments, etc. However, we can extend that as well to what your reporting requirements might be. So I would say, based upon your reporting requirements, so let's go back to the MTL example. If I'm an MTL license holder and I need to report to each individual state, I would want to track which state each transaction is taking place in. Additionally, if one of my requirements might be, how many funds are moved through each individual customer or their customer balance, etc., adding on individual, maybe a reference number to a given customer ID, or maybe the payout partner ID, etc. Wherever you're moving those funds to, those can help you for internal reporting needs. However, externally, you might need to report there as well. So at a minimum, I would say, where are you doing business within? And as well, what is the classification of this given leg of your payment, right? Is this the extinguishment of your liability? Is this the starting of it? And just being able to report on it there. Jack, I don't know if you've seen other examples that you think would be helpful across customers.
Yeah, I think from a reporting perspective, it's just always important this is probably just a rule for any project like this, is just to work backwards from requirements. So what we've seen in practice is businesses articulating all of their reporting requirements, financial requirements for their own books, setting aside even regulators and external reporting, and then also potentially even product requirements. It all depends on what their priorities are. But you work backwards from all those requirements to define what metadata you're attaching upstream in your own system, and then also how you define your chart of accounts itself. Because I think what we've seen in practice with talking with different businesses is that defining your chart of accounts in a particular way can hamstring your ability to do some of these things. And so it's also critical not only to attach metadata to make it easy to query on this information, but also to structure your chart of accounts in such a way that, to Foster's point, you are tracking these steps within your flow of funds that might have a lot of, they might be critical. So as he pointed out with MTLs, you have to understand when you are creating a liability versus extinguishing that liability. And so defining that as a step between, say, ledger accounts within your chart of accounts makes it a lot easier to timestamp that and understand what happened there. So yeah, that's all I would add to that, would be working back from those requirements.
Yeah, makes sense. Well, that is all the questions that I see. Thank you again to everybody on the call for joining us today, and thank you to our speakers, Foster and Jack. As a reminder, we'll send out a recording of this Tech Talk soon. And I also wanted to draw your attention to 2 upcoming events that are pinned, I believe, in the chat. One is the virtual product demo live on October 16th. And then if you're in New York, we're hosting a happy hour on October 21st as part of our developer session series. Foster will be there, so you could come see him again and get some of these stories firsthand. Links to register for both of these are in the chat. And we'll end it there. Thanks again, everyone.
Thanks, Chris. Thanks, Jack. See y'all soon.